Hey, what's up, D3 traders? I hope you're having a great week so far. I wanted to share with you one of my favorite tips when it comes to the 200 period moving average. As you might know, as you can see on my charts, I don't use any indicators other than the moving averages, and you can say volume. Volume is an indicator. Mainly, I use the 200 period moving average, which is the red line, and the 20 period simple moving average, which is the blue line. I'll do a video at some point about the 20 MA, but for today, I have a few things to share with you about the granddaddy of all moving averages, which is the 200 period moving average. Okay, so to get started, the first thing I want you to know is when you have a gap, if you're a gap trader like myself, and you have a stock that gaps just above the 200, it is extremely likely that it will get bought right at the open. See this? A gap just above the 200 and then bam, big pop. Let's take a look at the SVRA a while back, but the same thing. A gap above the 200 gets bought, right? PTI, a gap under the 200 gets sold. Now, keep in mind that if the stock gaps well below the 200, it may initially run up into it and then get sold. But usually 90% chance it'll get sold, regardless of the quality of the gap. You might think, well, this wasn't such a good gap. It doesn't matter. I've rationalized my way out of bad gaps that were gapping under the 200 way too many times. Meaning, I've said to myself many times in the past, oh, I'm not going to take this trade. It's a bad gap. But if it's gapping under flat 200, it's good. You can automatically almost upgrade the gap. Now, it doesn't have to be exactly flat. It can also be a bit rising or declining. But when it comes to the 200 period moving average, flatness is truly king. Is king. The 20 period moving average, it's most powerful when it's trending. The 200 MA is most powerful when it's flat. I also remember Tesla. So UNFI, right? Take a look at the Tesla not too long ago, gapped above the 200, pulled back, didn't reach it, but got bought anyway. Often they reach it and then they bounce off of it. Today we have air, but that wasn't the gap that I wanted to talk about. I saw this a couple of days from last week, and I thought, oh, I'm gonna talk about it. Not only does it get sold when a stock gaps under the 200, but when you have a gap, let's say well above it, and it drops to it, big drop to the it usually will bounce off of it, like we see here from a month ago, let's say, on air. How about Tell? A gap well below the 200, still got sold. To Tell, now why am I bringing this up? Because this was on today's gaps list, so I saw that and I thought, okay, I'll mention it. But even if it's well below the 200, I mean, not way down here, but even if it's a little bit, below the 200, not right below it, it still will usually get sold. And again, just like I showed you on the air here when it sold off hard into the 200 and got bought, here's this. Gapped way above the 200s, got sold, and where did it stop at? Right at the 200. APDN also from yesterday, gapped way above the 200, got sold, but where did it stop? Where did it bounce off of? So if you're looking at this and you're looking at the intraday charts and you're thinking, oh, this is setting up long. I don't maybe quite like the setup, but wait a second. It's right at the 200 MA on the daily chart. Bam. You should automatically look to upgrade the play from maybe okay to excellent. But to tell you the truth, that's not all. That's not everything. If you are purely a day trader and you don't even look at the daily charts, I took some pictures to show you. Look at this. A huge sell-off on the 15. I call this play the Haas play. Stops the stock dead in its tracks on the 5-2. It's better when there's multiple time frame alignment. right? If you look at this other play that I took a picture of, a multi-bar run up into the flat 200 on the 15, into the flat 200 on the 5, bam, worked short. On the 15, look at this, guys. Down, 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 the biggest bar, biggest volume at the 11:15 reversal time, and into the 200 period moving average. Perfect. That's a perfect long. Again, I love it when it happens on the 15-minute chart, but really the moving average applies. This rule that I'm sharing with you applies to any and every time frame. Now, if you like to take core, if you play core, meaning position trade, long-term plays, or even swing trades, I always like breakouts that originate from the area of the 200 MA. Let me show you what I mean. See this? Look at this. When I see that the stock is breaking out from the 200, sometimes it's below it, sometimes it's above it, but from the area of the 200, this is the sort of breakout that I want to play, or that I want to get involved in. NBEV. I see that it tries to break it, multiple bars up into the 200, gets rejected. It pop into the 200, gets rejected. It pop into the 200, gets rejected. Finally above it, guess what? That's the thing I want to play, right? Knock 3 times, once, twice, 3 times, and then the 4th time takes it out. And IHD, this is a bit old, but look at this. Broke out from where? You tell me, from where? Right from off the 200, and look at the move. 500% probably or so. ASNA, this I played actually as a long-term play. Look at this. Where did the breakout originate from? Where did the move come from? From the 200. So again, this rule about the 200 MA, I was in the NVAX just a couple days ago. From the 200. The rule that I'm sharing with you about the 200 MA is not applicable only to day trading or gap trading. It is definitely applicable to swing and core trading too. Look at the sell-off right into the 200, get stopped. Where did this breakout come from? The 200. This was not as tight, so I don't. This was actually great on the monthly chart. Legacy as a higher low transition A. Weekly was good too, had a monster move. But again, this is applicable to all time frames. All time frames. The larger the time frame, the more significant it is. I was looking at the PM just today, today, as a possible transition A. So what's transition A? The 4-stage cycle, right? And that's transition A when the stock goes from stage 1 to stage 2. But look at it. Is it near the 200? Is it like basing above it, or no, it's well below it? Guess what? Not interested in it. Does that make sense? Not interested in it. I like the ones that originate off the 200. I don't remember this symbol off the top of my mind. MYRM or RYAM or RYAM. Look at the gap. But this is not why I'm bringing it up, because I played this as a core play. I just want to show you what happened. Take a look. What a beauty. When you have a rising 20 MA and a flat 200, this is the squeeze play, right? The pinch play. And then you have a higher lows, right? Equal highs, and finally the 20 MA. This is a shakeout on volume, which was good. And finally that 20 MA pinches the stock from underneath the 200 and it pops. Perfect. I was actually in it for a long time. So that's the RYAM. I'm glad I remember the symbol because this was a pretty good one, pretty good example. And then here, apparently a few days ago, I didn't have this on my list, or maybe, oh, that's more than a few days ago, a month ago, gap just above the 200, pulled back to it. It wasn't just above, it was kind of well above, pulled back to it, and then got bought, right? So just keep that in mind about the 200 MA. You might say, isn't that a line on the chart? Yes, it is. And I am all for being objective and focusing on price action, not lines on the chart, not indicators. I do not advocate using indicators. But because there are enough people that use these moving averages, such as the 200 and the 20 MA, those are the most probably, I would say, commonly used moving averages. the 200 being a long-term moving average, the 20 being a medium-term to short-term moving average, they react, the prices react to them. It becomes a self-fulfilling prophecy. If everybody buys at this line on the chart, guess what? It's gonna be just as though it was a price support. Does that make sense? So it acts as support, whether you like it or not, right? Whether it's objective or subjective support. In this case, it's subjective. It's a Western tool designed to locate support, and it works. Enough people use it, so it works. No problem. I'm going to use it too. I'll do a video at some point about the 20 period moving average, which to me is even much more important because I'm a trend follower, a trend trader, and the moving average works best in trending markets. And so those are the kind of markets or stocks that I focus on, trending stocks. So I'll do a video at some point about the 20 MA. But I have to say, people that bash the moving averages and they don't know how to use them. That's the thing. I'm all for being objective and doing away with any and all indicators. The moving averages are indicators, but they're also directional tools. So they help in many different ways. They help smooth out the chart. You can read I can read trends and charts much faster when I have moving averages on the chart. So again, I'm all for using just pure candlesticks and volume maybe, but these tools are very helpful, and I hope you agree with me. I hope you enjoyed today's video. If you'd like to learn more about what I do and want to watch what I do and participate in some of the trades that I call, feel free to check out the Black Room. Link is in the description. Have a great rest of the week and take care, everybody.